Diversifying your investment portfolio is an essential strategy to manage financial risk and optimize returns over time. By spreading your investments across different asset classes, sectors, and geographic regions, you minimize the impact of any single underperforming asset on your overall portfolio. This approach helps maintain balance, stability, and growth potential, regardless of market conditions. Before starting, don't forget to like and subscribe to our channel for more future updates. What is diversification? Diversification involves spreading your investments across multiple asset types to reduce your exposure to any one particular risk. The idea is to create a balance that can protect your portfolio against volatility, offering more stable returns over time. It is based on the principle that different asset classes react differently to economic events, and by investing in a variety of them, you can cushion the blow of negative market movements. For example, while stocks may perform poorly during a recession, bonds or commodities like gold could rise in value, providing a counterbalance. Diversification doesn't eliminate risk entirely but seeks to manage it more effectively. Why diversification is crucial? The primary purpose of diversification is to reduce risk. It ensures that no single investment dominates your portfolio's performance. Instead of relying on one asset class to deliver returns, a diversified portfolio balances potential losses and gains across different types of investments. This method helps you protect your capital, maintain more consistent returns, and weather financial downturns. Another key reason for diversification is to preserve capital while still having exposure to growth. Certain asset classes may have lower risks but also lower potential returns, such as bonds or real estate. These assets can provide stability, offsetting the higher volatility and risks associated with growth-oriented investments like stocks or alternative assets. Key strategies for diversifying your portfolio. Asset allocation. A fundamental way to diversify your portfolio is through asset allocation, which involves dividing your investments across different asset categories. The main categories include stocks, bonds, real estate, and cash or cash equivalents. Each asset class has its risk and return characteristics, and determining how much to allocate to each depends on your risk tolerance, investment goals, and time horizon. Stocks tend to offer higher returns over the long term but come with more risk. Bonds provide more stability and lower risk but usually offer lower returns. Real estate investments offer a hedge against inflation and can generate passive income through rent. Holding cash or equivalents like money market funds gives liquidity and ensures you have quick access to funds for other opportunities or emergencies. Balancing these categories according to your individual goals allows for diversification, giving you exposure to both growth and income-producing assets. Sector diversification. Within each asset class, sector diversification ensures that your investments are spread across different industries. For example, if you invest solely in technology stocks, your portfolio could suffer if the tech industry experiences a downturn. By investing in various sectors such as healthcare, finance, consumer goods, and energy, you mitigate the risk of any one sector severely impacting your returns. Each sector reacts differently to economic cycles. Defensive sectors like healthcare and utilities tend to perform well during economic downturns, while cyclical sectors like technology or industrials may outperform during periods of economic growth. Diversifying across sectors helps ensure you're prepared for a variety of market conditions. Geographic diversification. Investing internationally is another key component of a diversified portfolio. Geographic diversification involves investing in assets or companies from different countries and regions, which can help protect your portfolio from risks tied to any one nation's economy or political landscape. While domestic investments may be more familiar, global markets often provide access to higher growth potential and new opportunities. By diversifying across developed markets such as the US, Europe, and Japan, and including emerging markets like China, Brazil, or India, you can capitalize on growth trends in different regions. International investments often have lower correlations to domestic markets, providing an added layer of protection against local economic downturns. Diversifying within asset classes. Beyond sector and geographic diversification, it's also important to diversify within each asset class. For example, if you're investing in stocks, you might choose a mix of large cap, mid cap, and small cap companies. Larger companies tend to be more stable and generate consistent returns, while smaller companies may offer more growth potential but come with higher risk. Similarly, in bonds, you can diversify by choosing government, corporate, and municipal bonds, which offer varying levels of risk and return. Government bonds are usually safer but offer lower yields, while corporate bonds provide higher returns but come with greater risk. For real estate, diversification could mean investing in different types of properties, such as residential, commercial, or industrial, or considering real estate investment trusts, REITs, which pool funds from multiple investors to invest in large-scale properties. Consider alternative investments. Alternative investments can further diversify your portfolio. These include assets like private equity, hedge funds, commodities, and infrastructure investments. Alternatives often behave differently than traditional stocks and bonds, providing a way to hedge against market volatility. For example, commodities like gold tend to rise during periods of inflation or market downturns, offering protection during economic uncertainty. While alternatives can add diversification, they also tend to be more complex and less liquid than traditional assets, so it's important to evaluate their risk carefully and ensure they align with your investment goals. Rebalancing your portfolio. Once you have a diversified portfolio, it's important to regularly rebalance it to maintain your desired asset allocation. Over time, some investments may perform better than others, causing your portfolio to drift from its original allocations. For example, if your stocks outperform, they may take up a larger portion of your portfolio, increasing your risk exposure. Rebalancing involves selling some of the overperforming assets and reinvesting the proceeds into underperforming ones, bringing your portfolio back in line with your original allocation strategy. This disciplined approach helps manage risk and ensures you stay aligned with your long-term investment objectives. Understanding correlation. Diversification is more effective when assets have a low correlation, meaning they don't move in the same direction under the same market conditions. For instance, stocks and bonds often have a low correlation because stocks tend to rise during periods of economic expansion, while bonds perform better during downturns. Including assets with low correlations in your portfolio ensures that when one asset class is declining, others may be holding steady or even increasing in value. Diversifying into assets with negative correlations, such as stocks and commodities like gold, can further reduce overall portfolio risk. When stocks drop, commodities may rise, offsetting potential losses. The role of ETFs and mutual funds. Exchange-traded funds, ETFs, and mutual funds offer an easy way to diversify by pooling investors' money to buy a broad range of assets. ETFs track the performance of a specific index or sector, giving you exposure to a wide variety of companies within that sector without having to pick individual stocks. Mutual funds, on the other hand, are actively managed by professionals who select a range of assets based on specific investment goals. Both ETFs and mutual funds provide diversification within a single investment and are particularly useful for investors looking for low-cost, hands-off ways to diversify across asset classes, sectors, and geographies. Conclusion. Diversification is the cornerstone of a solid investment strategy. It allows you to manage risk more effectively by spreading your investments across different asset classes, sectors, and geographies. A diversified portfolio helps protect your capital, stabilize returns, and ensures that no single investment dominates your financial well-being. The best diversification strategy depends on your risk tolerance, financial goals, and investment horizon. Whether you're looking to balance risk with reward or hedge against market volatility, a well-diversified portfolio will give you the flexibility and security to achieve long-term financial success. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.